Welcome to another episode of The Brand Called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from hundreds of successful individuals from around the world. I am your host, Ashutosh Garg, and today I'm delighted to welcome an accomplished investor and entrepreneur, Shashikant Chaudhary from India.
Thank you.
Welcome to the show, Shashi. As I mentioned, Mr. Chaudhary is an angel investor and serial entrepreneur. He's the co-founder of Thrive. He's the former managing director of Global Logic India, as well as on the several boards, including IIM Jammu. He's an investor and a mentor and invested in over 20 startups, and he's been recognized and felicitated several times for all the good work he's doing in and around his city and in India. So, Shashi, let's talk first about your role as an angel investor and a serial entrepreneur. And for our young viewers and listeners, tell me, what is the difference between an angel investor, venture capital, and private equity?
Thank you again. And to the point, in terms of the question, the angel investor typically is normally a first investor who keeps a faith on the founder. Mm-hmm. I mean, maybe that's a stage when the idea is not fully formed, or maybe in the prototype. So he's the first professional individual investor to say, and the first kind of a round of funding you can expect. Typically in India, it's anywhere between 5 lakhs to 25 lakhs. Typical, but some people can put 50 lakhs to 1 crore, but I am talking about typical range. The venture capital will typically come little later. And these are the professional institutional bodies. Mm-hmm. And these venture capitalists will invest anywhere between $2 million onwards. Mm-hmm. So $2 million to $10 million to almost like $30 million. That's the space which is called as the early stage venture capitalist and the late stage venture capitalist. Okay. But beyond that, if you want to scale, then the private equity comes into the picture. And the private equity would be typically $50 million to $200 million. That's the range. So basically you divide the investors by the stage of the company, mm-hmm. and by the ticket size, what I called as like 50 million to 200 million.
Wonderful. And you are an investor yourself. What are some of the key metrics you look for before you make an investment?
So typically I am an individual angel investor. So, the first thing which we look at from our perspective is the team. Because at the end of the day, the team is going to make it happen. Mm-hmm. A brilliant idea, but an average team would not make a success. Mm-hmm. But even, so-called average team, but average idea, but a brilliant team would really make it happen. At the end of the day, it is all about the execution. Mm-hmm. The next point we look at is market size. What's the market opportunity we are talking about? And at the same time, is this market growing? Mm-hmm. Because it should not be the only market size, because market size today could be good, but it could decline. That's number 2. Number 3 is, are they really solving a pressing need? Okay. I mean, it's a between must to have and good to have. If they are solving a problem which is must to have, that's better. Let me look at whether they have an elegant solution to the problem. I mean, many times problem is good to be solved, but the solution is not that elegant, which customer expects at that point of time. And at the end of the day, really speaking, we are trying to look at, or any angel investor or investor is trying to look at, what is his unique story, the startup's unique story in the big picture. So in the big story, what is his unique story?
Fascinating. That's very, very well articulated. Thank you. So, another question that is often asked is, for a startup entrepreneur, how long should a startup entrepreneur bootstrap, and how long before they start to raise money?
In a way, as we talked about the funding, the initial money is normally yours, then the friends and families, that's where you get your next immediate funding. The best money or the best funding is a customer funding. If you can fund your company through the customer's money, that's the best option. The next thing is, you require an oxygen and a petrol, both, to run the your vehicle. So sometimes you require oxygen, and when you require oxygen, you need to take that much of funding to just make those things happen. But when you really want to scale, you really require petrol, and when you require that, you need to go to those agencies. I have never seen, I mean, that's a very common statement, never seen a billionaire who had not made millions first. I mean, unless your company makes money for yourself, it's no point in going outside and taking money. So the point is, you take initial, fund it yourself. Second option is take money from your friends and family. The angel investors, yes, they come in at the first stages and they will help you out, but they are not really pressing you in terms of, the institutional investors would press you. So take that money, take the customer's money, prove your business model, and then, you should go for serious level of funding. So that's the point. But you need to start building the relationships right from day one. It's no point in digging the well when you require water. You need to build those relationships. So I would say start it from day one.
Well said. So another question that is often raised about angel investors is, how much should an angel investor get involved in the governance of a startup?
Yeah, I mean, there are different types of angel, but he should never get. Because there are those different hats. Angel investor investing is one hat. He could be advisor if asked, if properly requested, and if he has a capability, if he has an understanding of that domain, yes. Otherwise, he should only limit his role in terms of providing the connects and the introductions. And if he is from that particular domain or from that particular function, yes, definitely he can take up an advisor role. But that's an arrangement which has to be separately, formed between the CEO of the company and the angel investor. And yes, in some cases, I've seen, because many of the angel investors get into spray and pray model, some angel investors are serious. I mean, they get into high touch model. And when they get into a high touch model, they take care of the specific functional responsibility on a part-time basis, which means they get involved to the extent of 3 to 4 to anywhere 7 to 8 hours per week. But for that, they will take more and more equity. But typically, angel investors should not.
Fascinating. And at what stage do you look for an exit of your investment?
So typically, as every investor looks for an exit because he has to keep his money rolling. So the angel investors typically would look for an exit at a Series B level, because at that time, the stakes have grown, the professional investors have come in, and these professional institutional investors would offer an upside to the angel investors. So typically, it's a cycle of 4 to 6 years. Between the 4 to 6 years, the angel investor should get, if at all, I mean, because of the success ratios we always talk about, because you make winners and some are average and some are losers. But whenever you get those winners, typically it's a horizon of 4 to 6 years, and typically after Series A and mostly at a Series B.
Wonderful. And based on all your investments and track record that you have, there must be some that got away. I'm wondering whether you'd like to tell us. Maybe you don't want to name companies, because every investor has something which says that, I wish I had invested at that time. They came to me at such an early stage.
Many times. And, one of these companies, I don't mind, giving you the name. The Knowledge is one of that company. And, I just felt that, at that point of time, I would have been, little diligent. I would have taken more interest and really invested. And, it's not a good feeling when you hear every time the news of that company making strides and you had a chance to be part of it, and you did not take it, you curse yourself. So that's a feeling. It's like, some role is offered to you in a particular Bollywood movie and that movie becomes hit, you repent it.
I agree. But, again, I've been wondering what is, we've had, I think in India, 21 unicorns in 2021 so far. And we still have another 3 months to go.
Yeah.
What is it that India is doing differently now that it has got so many young companies that are becoming unicorns?
So I think one of the very interesting thing that has come up in the last 3-4 years, possibly, and now we are seeing the effect of that, is this decade per se would be called as a SaaS decade for India. And many times when you create those companies like the Freshworks, right, and those kind of companies which are like the SaaS model based, the advantage of creating that company in India using the large technology base, but becoming a global player in terms of customers in a much early stage. So that's where the difference is. Initially, the difference was, create a company, serve the Indian market, make sure that it is successful, and then try to go outside. But now we have started seeing that global SaaS players, and this is just a start. The global SaaS players have started emerging, the Zohos of the world and the Freshworks of the world. They have started emerging, and these are the players who would create this unicorn type of companies. And on the second side, this shared economy and the gig model, because of this specific, the class of the people start having now got into the mainstream of using this kind of services. Let it talk about Dunzo, or you talk about all those e-commerce kind of the companies which were there, right from the the Paytms of the worlds to all those companies where the cost of transaction has gone down, ease of the services has gone up, it has almost percolated to a common man. Almost. I mean, this is earlier, this was limited in terms of, let's say, the financial inclusion, the social inclusion, the education inclusion was limited to a kind of a tier or mid-tier. But now, even if you go to Buttewala or the roadside tapri operator also, and you can just go there, eat and pay by Paytm. I mean, that's where the usage has really multiplied. So I think these two factors are really playing out.
Fascinating. And since you know so much about technology, I would love to get your perspective on how has the pandemic, driven technology very, very deep in our country.
Yeah. I mean, one of the basic. I think we were at the perfect storm kind of condition. I mean, though the pandemic was not good, but what happened during the pandemic was the kind of the progress we as a India or as a whole world in terms of the adoption of the technology or the new kind of ways of consuming the services has really accelerated. What would have taken 10 years, we have taken 2 years. Okay. And at the same time, as I said, the access to the technology has become cheaper. Now we are talking about 15 to 18 rupees per GB. Of the consumptions, and average person is consuming 15 GBs to 20 GBs a month. Now, with that kind of the bandwidth cost, with that kind of the mobile handsets, which have become, easy for people to access. And at the same time, what India did best was in terms of creating the super infrastructure in terms of the financials. The financial infrastructure per se, what India has created can be compared to the kind of the infrastructure, roadways infrastructure that was created in 1945s, 50s in US. I mean, this is a super habit. Nowhere in the world you can transfer money just by email or by knowing his phone number. I mean, the way this infrastructure helped, and at the same time, what happened was this pandemic really forced the people to use those, and when they started using it, they found it convenient. I mean, nowhere people could imagine the 70-year or 50, 60-year or 80 years old people could operate out of the phone, Paytms of the world and phone pay of the world. They would be operating on the Zoom. They would be the complete education in terms of the way it could reach. The largest amount of content got created in these 2 years. Just imagine the way, and that is all captured. That is not lost.
Correct.
I mean, the kind of the ways when the people saw, oh, people can work remotely, not only in the remote office, but remotely from their home cities. The lot of work can be, you can get it done. People used to believe in earlier cases that work is to be done in a particular manner and particular method.
Sure.
And that perception changed when people got to see, oh, I can do my transactions, I can do my education, I can get health advice at my place, all those things just by leveraging the technology. And when people saw, oh, this works, and the efficiency has not dropped to the extent what we believe, that's a new world now which we have started seeing.
Very interesting. So, before I ask you a few questions on startups, I just was looking, and you're the co-founder of Thrive. Tell me, what is Thrive and what do you do there?
Yeah, so in terms of the Thrive, that was the part which we were doing the validations. But now I've shifted to a new startup. Okay. So I've started a new startup which is going to launch in the month of October itself. Okay. The part of the Thrive, we were doing the customer validation, and we were just trying to find out how the customer responds to a given way of trying to solve the problem. And I felt at that point of time, the time is, not maybe a right time to get into. Probably a year or two, it will require to get into that space. So I thought that better I would start a new company. So now I am starting a new one, which is in the stealth mode right now.
Fair enough. So let me come back to startups. 3 or 4 questions on startups. I think we have time for that. Based on your experience, is it better for a startup founder to go solo or have a co-founder?
It's you need to have, if given a choice, you need to have a team of 1 or 2 or 3 co-founders. Beyond that, it probably makes little noise, because you're trying. It's not a sequential thing. Number one, and there are too many things to be done at the same time, which is like in concurrent. It is just like, imagine you are running a race and there are 10 different tracks, and you yourself are running on 10 tracks. It's not physically possible, and you have to work at the speed of the light. I mean, the speed is the essence when it comes to the startups. Now, you might not have the requisite kind of skill set in those areas. You might be good in 1 or 2, but it's very difficult to imagine to be really expert and have that kind of a time bandwidth to really take care of all those 10, 15 different areas which are so important and to be done concurrently. So if you can get those co-founders who have a complementary skill sets, would tremendously help.
And, we spoke very briefly about startups succeeding and startups not succeeding. And the general numbers that are thrown around are 1 out of 10 succeeds. So my question to you is, what are some of the basic mistakes a lot of startup entrepreneurs make?
Yeah. So first and foremost, let's try to find out what succeeds and not succeed. Their definition. Succeeds from the investor's point of view.
Correct.
Is a different, because he wants to make it unicorn. If he doesn't make a unicorn, he feels that has not succeeded. But even a $20 million, $50 million company is a successful company. We should not, because that perception that every one, 9 companies out of 10 fails, perhaps that needs to be little corrected. But but the kind of the mistakes people typically we have seen is, they spend a lot of money upfront before really validating where the customer needs that particular product and whether that problems need to be solved in a certain manner. So that's where they spend a lot of time, a lot of money upfront. And then when the product comes to the market, the customer requirement is somewhere else and the product is at somewhere else. That's, I think, and that by that time, a lot of time and money has gone. And that creates a problem. One of these, thing which we typically see, that they create these products in isolation. They need to create the product in sync with the customers. So that's where, creating the product in sync will always, you create, you show, you get the insights, you modify, then you create, then you show, then again, that cycle that cycle sometimes is missing. Sometimes they develop a product, they feel that they are developing a product which is less differentiated. Now, less differentiated, that margin can be quickly covered unless you have sufficiently differentiated product or better, a disruptive product. I mean, where you are offering almost like 5 times, 10 times the efficiency at 3 times lower the cost. But many times you have seen that they go for a less differentiated. And many times what we have seen is that whatever their assumptions are right at the start, right, when they are building the product, even for 2 months, 3 months to 6 months, the average is the 60% of those assumptions would prove wrong when you get to the market. So go out of your office, go to your prospects or the prospective customers, talk to them, and in conjunction with them. So there are these 2 parallel tracks. One has to be a product development track, and second has to be a customer development track. And these 2 tracks have to remain and run in sync.
Fascinating. So, Shashi, now time for 2 more questions for you. My next question is on values. Not only are you an investor and support so many startups, but you've been recognized so many times at different fora across the whole country. I want to ask you, what are some of the core values you believe in?
So the core values is, for me, my parents and, those people really imbibed that treat anyone beyond his role. Primarily, if you are able to treat anyone as a person rather than his current role. I mean, that would be the foremost. And the second would be I think in the long run, integrity. That's the most important thing, because anything can be recovered. Integrity, if it is lost, people won't trust you, the employees won't trust you, customers won't trust you. So winning the opportunity, at the cost of integrity is a loss in entirety. In all probability, it's the worst idea. So I think these are the 2 basic things I would say.
Wonderful. And my last question to you, and this is a question on failure. I actually have a new book that was published in March on failure. I have often said that parents in South Asia or India don't teach children it's okay to fail. They're always taught class mein first aao, go to the head of the line, and so on and so forth. And that manifests itself in our behavior patterns. Yet we fail, we learn. My question for you is, what have been your learnings from some of your mistakes?
Yeah, you're absolutely to the point, Ashutosh here. I mean, we fear too much about the failure. So there is a fear of failure. And most of the times, people prepare the strategies for not to fail. But if you are preparing the strategies for not to fail, then your ability to jump and create an extraordinary, winner gets limited. And I failed too in multiple number of times. And, one of the things that really came handy was the family support. But at the same time, as you fail and you create a mechanism to size up that failure and create a mechanism to respond to that failure, then you can take the failure in your stride, and then you don't tend to fear the failure too much. So as long as your fear of the failure is less than your hunger for success, nobody can stop you. I mean, at no point of time, then what happens is that you are not worrying about the competition or enemy or those kind of things that are you going to fail, because now you have created the response mechanism, how to respond. I'm not saying react. And one of those things that came really very handy to me, is to create your own mechanisms of your response. So one of the mechanisms was, that came in fact from the book, and that was from the L. Rice and Jack Trout. So, as long as you can hit the enemy or the competition at its weakest point by your strongest force, you can hope to win a battle. And I'm saying that not every time, I mean, all the strategies in the world, they talk about winning the war. Winning the war is the ultimate thing, but there are always small battles which are played in those wars. Even winning the war, even winning the battle for some time. So, I coined my own sort of a sentence out of that. And I said that, winning a war is a choice, but losing a battle is not the option when you are doing a startup. So those are those kind of things.
Fascinating. And on that note of winning a war is a choice, but winning a battle is not an option for a startup. I think, Shashi, thank you so much. It's been such a privilege speaking to you. Thank you for so much of your knowledge that you have shared on startups and such amazing advice to startup entrepreneurs and potential startup entrepreneurs. Thank you very much and good luck.
Nice talking to you, Ashutosh, and it's your unique ability to bring best from speaker. Thank you.
Thank you, sir. Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.